Hi all, Tony Daly here with a midday trade I just put on Goldman Sachs. This is an options trade. Looking at this is my chart that I use, my volatility chart. I have superimposed here implied over historical, and we could see that implied is over the historical volatility on the daily chart. So we've got some pretty good premiums, however, and basically that gives me a good idea of what type of strategy to use. And on my chart I have two linear regression channels, a 50 and 100 period linear regression channel, and we could see currently then in the dotted line here is my 200 period moving average, which is my line in the sand. This should hold as major support, as Goldman hasn't violated its 200 moving average in some time now. So anyway, the trade that I put on is, I believe, since we are at the bottom of the regression channel and we've had a move up today, I think a lot of the bad news for the banks has been baked in, and I think they're ready. I think Goldman is ready to move back inside its 50 period regression channel, as you can see it's been doing, and it should fill this gap. So all that being said, if we go to the Analyze tab, what I did was for October, you can see down here I put in a 155, 160 vertical call spread, and that costs 220. So basically I cost 220 and it's worth $500 minus 220, so the most I could make is $230. What I generally do with call spreads is I look to finance them by selling a put on the other side. It's known as a risk reversal. However, the true definition of a risk reversal is to buy a call and sell a put. I bought a call spread and finance it by selling a put. So it's kind of my version of a modified risk reversal. So going back to the chart, I look to see where my strike should be, and I want to put it just under the 200 period moving average. Now, by selling a naked put, I have to be willing to own 100 shares of Goldman Sachs at $145 regardless of where the price is, just by virtue of definition of a naked put. And I'm okay with that. So you have to be willing to do that. So what I also did was I sold a 145 put. I collected $2.58, so the net for this trade was a credit to me of $38, which covers all the expenses. So basically I have a quote-unquote free trade on, which I collected $38 on, and I have my risk is below 145, my reward is above 160, my full reward is $230 for the vertical call. And basically let's take a look at the risk profile of that. So the risk profile shows the current position right over here, and we see the expiration line is the red line and the position line is the white line, and as time goes on this is going to go up or down. My true break even at expiration is right here at 144.63, and if we also look at the 68%, the standard deviation, it is outside of these lines. So all that saying, I think it was a pretty sound trade, and I do these kinds of trades a lot, and we'll just monitor it and follow it and see how it goes. So thanks for watching, and we'll see you soon.